Okay, in this second video, we're going to continue where we left off last time and talk about the real estate market cycle. Looking for my devices here so I can draw along here, but this is just a really general kind of a view of the real estate market cycle, and we'll talk about kind of big picture ideas as we'd move through the cycle and what things might look like. So we'll just start over here on the left and take a look at this point, and we're as we travel along this way on the cycle, we would be in the recovery phase. And so up here at the top, you can see that that would be consistent with improving occupancy, right? So we could look at occupancy rates in the market, and they would be trending in a positive direction. They would be improving. Rental rates would also be starting to improve. Maybe we'd see some slight growth or definitely some leveling out of rental rates. They wouldn't be declining anymore as they would if we were in the downside of the market cycle. So we would see tenant health improving, and prices for property would probably be stabilized and maybe even starting to tick up a bit as we're into the recovery. As we move deeper into the recovery and we get closer to the market top, we're going to be firmly in that expansion portion of the market. And so things we might see would be low vacancy, maybe even very tight market where it's difficult to find space. We would see high rental rates and high rental rate growth. All right, so the rents going from year to year, we might see 8, 10, 15% growth in rental rates from where they were the previous year. It's likely that we would start to see a pickup in development. So real estate developers would start to go out and get projects going, start them moving, maybe even start construction as we will definitely start construction as we're moving into that expansion portion of the market. The TI packages, this is the stuff that the landlord is offering to a tenant to move into their space, is going to be more modest because this is definitely very much a landlord's market, because they have the buildings, they have the space, and space, there's not much of it going around. They're going to be able to kind of dictate terms and control the market. So they're going to try to do the best that they can in terms of negotiating and be able to get as much as they can from tenants. They might ask for long-term leases and not offer a whole lot in terms of concessions. Real estate cash flows and the returns would typically be quite high during this phase. Everybody looks smart when the market is high. I'm not sure which investor said it, but a rising tide lifts all boats, right? Even dummies look like they're smart because of what they bought in the past. Now, this will last as long as the demand stays high and that there's not a whole lot of new supply coming on the market. If there's not a whole lot of deliveries, then there's going to continue to be pressure on occupancy. There's going to continue to be a lack of space, and so as long as tenants are doing well, their financial health is keeping going, then we're going to be in that expansion phase of the market, and things will be really good from the investor side. Much more difficult from the tenant side of things. Now, as we move further on this in this continuum and get down to this kind of balance area here, you can see that occupancy is right at the normal range for occupancy, and so we would call that kind of an equilibrium type of arrangement. So we would have normal rental rates. We're going to have normal kind of growth in rental rates. Maybe it's just like with inflation, not a great deal of change in rental rates. There's not going to be a whole lot of demand for new development because we got this nice balance between the space that's being supplied and the space that's being demanded. And so this is kind of a nice level thing. There's nothing exciting from the ownership side of things. So you're not going to have incredible returns at this point in time, but from the same side or from the different side, tenants are going to feel pretty good because they can usually find space if they need space. And if we continue to move to the far right of this diagram and move into the decline phase of the market, we're now seeing declining occupancy rates. Rental rates may not be going down, but definitely the growth rate is going down. And frequently what will happen as we get towards the bottom of the market is that rental rates really will be declining. So the growth rate will have gone negative. And last year's rental rates, maybe they were $20 a square foot. This year they're $18 a square foot. It's definitely very much a tenant's market whenever we're in that declining phase and near the bottom. So if you're a good tenant, a good credit tenant, you're going to have a lot more negotiating power. Of course, if you're a weaker tenant, it could be very well that the decline in the real estate market coincides with a decline in the overall market, and you as a tenant are struggling because you're having a hard time getting customers and keeping customers. So in this phase, if in a tenant's market, it's likely that landlords are going to have to offer higher TI packages. They're going to have to spend more money on spaces to bring tenants in there. Getting a loan, if you're trying to buy real estate, is going to be tricky because banks are going to be scared off by what's going on in real estate. Their loans are going to be hard to get from lenders. They don't like real estate. Real estate has fallen out of favor at this point in the cycle. Right, all the articles that you read in the newspaper are going to be about how real estate is horrific and nobody can make money in real estate anymore and that sort of thing. Marginal investors are going to be put under severe pressure, and many might even go to foreclosure. So they might lose their buildings if they don't have some money set aside, some cash set aside to kind of tide them over the difficult times. So that's a kind of a quick view of the market. And as we kind of think about those and talk about those, it's important from an investor side of things to really have a good sense of what's going on in the market. Market analysis is critical for real estate investors. So that means you need to understand the supply and the demand in the market, and in particular for the real estate property type that you are interested in. Because different property types, let me go ahead and get my highlighter here, different property types are going to have very different cycles and different dynamics. So there's not a one-to-one overlap. If multifamily is in decline, that doesn't necessarily mean that retail and office and industrial are in decline. These things might move through slightly different cycles. And so you definitely want to pay attention to the things that you're interested in the market that you're buying in. Employment growth and population growth are always going to be key indicators of a health in a real estate market. As long as there's good job growth, as long as people are moving to an area, that's really going to help buoy a market. Even if there's kind of an overall situation of a tough economy, if a particular area is doing well and has a lot of people moving in because of job opportunities, then real estate can hold up fairly well in that localized environment. You want to pay attention to the development pipeline. We've kind of talked about this. This is a big picture of what's going to be coming in terms of supply. And so we want to pay attention to the deliveries that are coming, when they're going to come, how big they are. If we're in the office market and all of a sudden there's going to be a 5% increase in the supply, that really has some big implications for the desirability of being in that market and the prices that we should be willing to pay to invest. Gross absorption and net absorption are a couple of key terms that we want to keep track of. So gross absorption, let's just talk about the gross. This is basically gets to the leasing activity, the leases that are signed, the move-ins that happen. So let's put the move-ins, and this could be office, retail, multifamily, whatever the case may be. So when new leases are signed and tenants move in, that's going to be counted in gross leasing. But what that kind of misses is that if there are move-ins, many times tenants are just relocating. So they might be moving out of one space, moving into another. And so a gross lease doesn't really give us a good sense of what's going on in the market as a whole. Whereas net absorption really does give an indicator of the overall health. So this is going to be things like we're going to add move-ins, and we're going to take away move-outs, and we're also going to subtract new deliveries. So if let's just do a quick example here, new deliveries. If we have 100,000 square feet of new leasing, so move-ins, but those tenants vacated 70,000 square feet of space, right? They moved out of 70,000 to move into 100,000 square feet. And the marketplace just delivered 200,000 square feet of new space, new office space. Then what we have here is negative net absorption, and we have there in total a negative 170. That basically says that of all the space in the market, there's now 170,000 fewer square feet leased than we have in supply. So that gives a sense that you're kind of moving the wrong way. If you have negative net absorption, that by necessity means that occupancy occupancy will be going down. So negative net absorption is consistent with occupancy going down. If we have positive net absorption, on the other hand, then we would see occupancy rates going up. So absorption and net absorption are key metrics in looking at market analysis. Let's move on to rental rates. So we have the whole notion of asking rates. That's how much landlords are kind of advertising the space for, what they're asking for in terms of rents for the space. And market rates, on the other hand, are where deals are actually being done. So those two can be quite different. And that takes into account things like concessions. So if landlords are offering free rent, maybe 3 months of free rent or 6 months of free rent for new deals, that's kind of affecting the effective rates that landlords are getting. And we also need to think about the tenant improvements, what's going on, and how that affects rental rates. So finally, we need to also think not only about what's happening right now, but we also need to be thinking and looking forward. What's going to be true in a few months? Is space going to be delivered in the next 60 days, the next 90 days, the next 6 months? Because as an investor, you're not going to be looking just at the right here and the right now. You're definitely going to be looking ahead because you're making a really big investment, and this is all going to be, future cash flows that you really care about. The same is very much true in the stock market, by the way. You're always kind of looking forward as you're making an investment. You don't make decisions based on what has happened in the past. You're making decisions based on the prospects of a company and its cash flows moving forward. So same thing is true in real estate, and that's why we care really a lot about market analysis and getting a handle of supply and demand, so we kind of have a sense of where things are going to be going in the future. All right, we've gone a little bit long in this video. We're getting close to 12 minutes, so I'm going to go ahead and stop here. And in the third video, we'll pick up with looking at some real estate investment strategies, and we're going to look primarily at these 4 kind of biggies. There are another dozen, I think, that the textbook talks about. Kind of gives a little bit of detail on. These 4 right here that we have are certainly not exhaustive. They don't cover every possible way that investors look at real estate and make decisions about that. But this gives a good broad overview, and it captures a fairly big chunk of the way people go about investing and the way that they think about real estate as an investment vehicle. So we will stop here and pick up in the next video and look at these real estate investment strategies. And so I will see you then.